Single Euro Payments Area.
The Single Euro Payments Area is a payment integration initiative of the European Union for simplification of bank transfers denominated in euro. As of February 2014, SEPA consists of the 28 EU member states, the 4 members of the EFTA, Monaco and San Marino.
Goals.
The project's aim is to improve the efficiency of cross-border payments and turn the fragmented national markets for euro payments into a single domestic one. SEPA will enable customers to make cashless euro payments to anyone located anywhere in the area, using a single bank account and a single set of payment instruments. The project includes the development of common financial instruments, standards, procedures, and infrastructure to enable economies of scale. This should, in turn, reduce the overall cost to the European economy of moving capital around the region, estimated as 2 to 3% of total GDP.
Overview.
There are 2 milestones in the establishment of SEPA. Pan-European payment instruments for credit transfers began on January 28, 2008. Direct debits and debit cards became available later. By the end of 2010, all present national payment infrastructures and payment processes were expected to be in full competition to increase efficiency through consolidation and economies of scale. For direct debits, the first milestone was missed due to a delay in the implementation of enabling legislation, the Payment Services Directive or PSD, in the European Parliament. Direct debits became available in November 2009, which put time pressure on the second milestone. The European Commission has established the legal foundation through the PSD. The commercial and technical frameworks for payment instruments were developed by the European Payments Council, EPC, made up of European banks. The EPC is committed to delivering 3 pan-European payment instruments. Credit transfers, SCT, SEPA credit transfer, direct debits, SDD, SEPA direct debit. Banks began offering this service on November 2, 2009. Cards, SEPA Cards Framework. To provide end-to-end straight-through processing, STP, for SEPA clearing, the EPC committed to delivering technical validation subsets of ISO 20022. Whereas bank-to-bank messages, PACs, are mandatory for use, customer-to-bank payment initialization, PAIN, message types are not. However, they are strongly recommended. Because there is room for interpretation, it is expected that several PAIN specifications will be published in SEPA countries. Businesses, merchants, consumers and governments are also interested in the development of SEPA. The European Associations of Corporate Treasurers, EACT, TWIST, the European Central Bank, the European Commission, the European Payments Council, the European Automated Clearinghouse Association, EACHA, Payments Processors and Pan-European Banking Associations, European Banking Federation, EBF, European Association of Cooperative Banks, EACB, and the European Savings Banks Group, ESBG, are playing an active role in defining the services which SEPA will deliver. Since January 2008, banks have been switching customers to the new payment instruments. By 2010, the majority were expected to be on the SEPA framework. As a result, banks throughout the SEPA area, not just the Eurozone, need to invest in technology with the capacity to support SEPA payment instruments. SEPA clearance is based on the IBAN bank account identification and the SWIFT BIC bank identifier. Domestic transactions are routed by IBAN. Earlier national designation schemes will be abolished by February 2014, providing uniform access to the new payment instruments. By February 2016, consumers must drop BIC sorting information for SEPA transactions, since it will be derived from the IBAN for all banks in the SEPA area. Multinational businesses and banks have the opportunity to consolidate their payment processing on common platforms across the Eurozone. They will benefit from the efficiency of choosing among competing suppliers, offering a range of solutions and operating across borders. The introduction of SEPA should increase the intensity of competition among banks and corporates for customers across borders within Europe. For consumers and organizations, SEPA should mean cheaper, more efficient and faster payment transfers when moving euros from one Eurozone country to another.
Coverage.
SEPA consists of 34 countries, 28 member states of the European Union, including the 18 states that are in the Eurozone, 10 states which are not in the Eurozone, Bulgaria, Croatia, the Czech Republic, Denmark, Hungary, Lithuania, Poland, Romania, Sweden, United Kingdom, the 18 states that are in the Eurozone, 10 states which are not in the Eurozone, Bulgaria, Croatia, the Czech Republic, Denmark, Hungary, Lithuania, Poland, Romania, Sweden, United Kingdom, the 4 European Free Trade Association member states, Iceland, Liechtenstein, Norway, Switzerland, Monaco, San Marino. All parts of a country are normally part of SEPA, whether or not the regions are part of the European Union. The following countries have dependent territories which are not part of SEPA. Cyprus, only areas controlled by the Republic of Cyprus are included. Other areas claimed by the Republic of Cyprus are exempted from EU law. Denmark, Faroe Islands and Greenland are excluded. France, everything except French Polynesia, New Caledonia, Wallis and Futuna and French Southern and Antarctic lands are included. The Netherlands, only the European part is included. The Caribbean islands are excluded. Norway, Svalbard and Jan Mayen are excluded. The United Kingdom, only Gibraltar is included. Excluded are the Crown dependencies, Channel Islands and Isle of Man, and all other British overseas territories. A few countries, and areas, using the euro are not included: Andorra, Kosovo, Montenegro, the sovereign base areas and the Vatican City State.
Misconceptions.
There is a misconception that all credit transfers in the SEPA are free to the consumer either by plan rules or national transposition of the Payment Services Directives. Banks and payment institutions still have the option of charging a credit transfer fee of their choice if it is charged uniformly to all EEA participants, banks or payment institutions, domestic or foreign. This is relevant for countries which do not use the euro. Domestic transfers in euro by consumers are uncommon, and inflated fees might be charged. In Regulation, EC, 924/2009, the European Parliament mandated that charges in respect of cross-border payments, of up to €50,000 to other member states shall be the same as the charges for corresponding national payments. However, the EU regulation does not apply to all SEPA countries. The most significant difference is the inclusion of Switzerland in SEPA but not the EU. The rule of the same price applies, even if the transaction is sent as an international transaction instead of a SEPA transaction, common before 2008, or if any involved bank does not support SEPA transactions.
Progress Report.
The official progress report was published in March 2013. In October 2010, the European Central Bank published its 7th progress report on SEPA. While acknowledging some progress since the last report, the ECB expressed disappointment at the volume of work remaining to bring the SEPA to fruition and requested banks, regulators, and the software industry to continue working. The European Central Bank regards SEPA as an essential element to advance the usability and maturity of the euro. SEPA went live in January 2008, but as of May 2012 only 28.2% of credit transfers within Europe were executed in accordance with SEPA standards.